Sustainable pension funds are investment vehicles that aim to reduce the impact of climate change and promote social and environmental values, while also fulfilling their fiduciary duty of providing adequate retirement income for their members. Sustainable pension funds use various criteria to select the companies they invest in, such as environmental criteria. These include factors such as greenhouse gas emissions, energy efficiency, waste management, water conservation, biodiversity protection, and renewable energy sources. Sustainable pension funds may avoid investing in companies that harm the environment or contribute to global warming, and favor those that have a positive environmental impact or offer solutions to environmental challenges. Social criteria. These include factors such as human rights, labor standards, diversity and inclusion, health and safety, community engagement, and customer satisfaction. Sustainable pension funds may avoid investing in companies that violate human dignity or exploit workers, and favor those that respect human rights and promote social justice. Governance criteria. These include factors such as board structure, executive compensation, shareholder rights, business ethics, transparency, and accountability. Sustainable pension funds may avoid investing in companies that have poor governance practices or are involved in corruption or fraud, and favor those that have high standards of corporate governance and integrity. Sustainable pension funds may use different approaches to apply these criteria to their investment decisions, such as exclusion. This involves screening out companies that do not meet certain minimum standards of environmental, social, and governance performance, or that are involved in controversial activities or sectors, such as weapons, tobacco, gambling, or fossil fuels. Engagement. This involves using shareholder rights and influence to encourage companies to improve their environmental, social, and governance practices, or to address specific issues or concerns. This may include dialogues with management, proxy voting, resolutions, or collaborations with other investors. Integration. This involves incorporating environmental, social, and governance factors into the financial analysis and valuation of companies, and selecting those that offer better risk-adjusted returns or growth potential based on these factors. Impact. This involves investing in companies that have a positive and measurable impact on environmental or social issues, such as climate change mitigation or adaptation, poverty alleviation, or access to education or health care. By using these criteria and approaches, sustainable pension funds aim to align their investments with their values and mission, while also enhancing their financial performance and reducing their exposure to risks. Studies have shown that sustainable investing can generate comparable or superior returns than conventional investing over the long term. Sustainable pension funds also hope to contribute to a more sustainable and equitable society by supporting companies that are responsible and innovative. Oil and gas companies are facing increasing pressure from investors, regulators, and the public to align their businesses with the global climate goals and reduce their greenhouse gas emissions. However, many of these companies are not taking meaningful action to transition to clean energy, but rather resorting to greenwashing tactics to create a false impression of environmental responsibility. Greenwashing is the term for a company's exaggerated, misleading, or unsupported claims about its environmental practices. For example, some oil and gas companies have been using green colors, natural landscapes, and phrases such as eco-friendly or low carbon in their advertising campaigns, while continuing to invest heavily in fossil fuel extraction and production. Some have also made public commitments to achieve net zero emissions by 2050 or sooner, but without providing clear plans or targets on how they will get there. A recent study published in the journal PLOS One examined the records of 4 major oil and gas companies, ExxonMobil, Chevron, Shell, and BP, which together are responsible for more than 10% of global carbon emissions since 1965. The researchers found that these companies have been increasing their mentions of climate-related keywords in their annual reports and strategies, but their actions do not match their words. The study found that these companies have not reduced their exploration activity, fossil fuel production, sales, or profits from fossil fuels. In fact, they have been expanding their fossil fuel reserves and planned production, which are already incompatible with the 1.5 degrees Celsius temperature target set by the Paris Agreement. The study also found that these companies have been spending very little on clean energy technologies, compared to their overall capital expenditure. According to the International Energy Agency, IEA, investment in clean energy by oil and gas companies was about 1% of their total spending in 2020. The researchers concluded that these companies' claims of being in transition to clean energy are not supported by evidence, and that they are engaging in greenwashing to maintain their social license and avoid regulation. Greenwashing by oil and gas companies is not only deceptive and unethical, but also harmful to the environment and society. It creates confusion and mistrust among consumers and investors, who may be misled into thinking that these companies are doing enough to address the climate crisis. It also undermines the efforts of genuine climate leaders and innovators, who are working hard to develop and deploy renewable energy solutions. And most importantly, it delays the urgent action that is needed to reduce greenhouse gas emissions and prevent catastrophic climate change. Therefore, it is vital that we expose and challenge the greenwashing practices of oil and gas companies, and hold them accountable for their environmental impact. We need to demand more transparency and honesty from these companies, and scrutinize their claims and actions against scientific evidence and standards. We also need to support policies and regulations that will incentivize a rapid and just transition to a low-carbon economy, and penalize those who continue to profit from polluting the planet. And we need to support the development and adoption of clean energy alternatives that will provide us with reliable, affordable and sustainable energy for the future.